now that we've exchanged our pleasantries, then you can hear me and I can hear you. So let's start with our market chat. Last time when we spoke to you, you were of the view that one should not buy mid and small cap stocks. And mid and small cap stocks have recovered, but marginally. But large cap stocks and mega cap stocks have been on a tear. Do you think this trend is here to stay?
See, I think, we believe that, market is approaching end cycle. And in end cycle, markets can rally very, very significantly. And it's very difficult to predict the end of the end cycle. In the 90s, an end cycle in America lasted 3 years. And in India in 2007, the end cycle lasted about 12 to 15 months. So, but this is that phase of the market where it is very difficult to predict what happens to the market in the next 3 to 6 months. But our view is that we have to be careful at this point of time because market valuations on large caps, with the exception of PSUs, export and manufacturing sectors, I would say that the rest of the market has become overvalued today. And consequently, we think we have to be careful everywhere except in export, manufacturing and PSU sectors.
That's interesting. Naren, when you say rest of the market is looking expensive, will that include everything outside of exporters?
See, actually, it's very difficult for me to say it is everything, but I'm saying broadly, if you look at it at this point of time, what you can clearly see is that most of the stocks are trading at reasonably high valuations. Some of them on market cap basis have also become pretty expensive. And today we have a scenario where you have a $18 billion trade deficit recorded in the last month for which data is available. So now $18 billion of trade deficit is a very large number, which means that it is much better to be in export, manufacturing and PSU sectors at this point of time because they are the gainers out of very high trade deficit and the continuously depreciating rupee. So I would say that, maybe there are individually stocks in many of the other sectors which are still okay. Like we find that corporate banks have underperformed for 7-8 years. So despite the recent rally, some of the corporate banks are not overvalued, but the real bargains are not in any other sector other than export, manufacturing and PSU, because you look at the breadth of the rally, look at the return over 5 years. Over 5 years, Nifty is given more than 100%, I think. And if you look at mid cap, small cap kind of indices, they have all given 200%. So when we speak at this point of time, we are speaking when the indices have done extremely well over 5 years. And I would say that, there is need for caution at this stage. And I believe that, one theme follows another. So if you look at the 90s, you had TMT theme. Then after that, you had an infra theme. Then you've had a small and mid cap and growth quality theme. And now I think we'll have to move to the export theme given the quantum of trade deficits that we have at this point of time.
But how would you play caution in the market, Naren, across all your funds? You've spoken about how export theme might be one area to find, the possibility of an alpha. Would you also raise cash? Would you turn to allocate more to defensives, which might be expensive in some of the private banks as they continue to perform?
See, in many of our closed-end equity funds, we have a fairly significant hedge on our equity portfolios. And if you look at our dynamic asset allocation funds, we have some of our lowest equity weightages in our dynamic asset allocation funds in the entire last 5-6 year period. I think in a few days our August portfolio will be revealed, and at that point of time you can have a look at what is our net equity position in all our dynamic asset allocation funds like the balanced advantage fund or the equity savings fund. We would have one of our lowest ever equity weightages in these funds. So I think we are as defensive as We can, in the categories where we are permitted to be defensive. In all the other funds, we are essentially running pure group funds. So, we have to keep in track what kind of weightage others have in each of the funds, and therefore there we are not hedged or something like that. But I would say we don't believe that it is difficult to predict when the market will fall. One of the lessons I learned in my end cycle experience as a fund manager in 2007 was that I thought markets were overvalued in January 2007, and the market went up 20% after that. And there is no reason why we can't have another event where again markets keep going up despite the market being overvalued. In our fact sheet, we publish a valuation model, and that valuation model has gone out of, it has gone into slightly cautious zones. But in 2007, the same valuation model, after the valuation model touched where we are today, the market went up almost 15 to 20% in Nifty.
Right, Naren, but if I look at the global setup, we are in a longest bull market for America after Second World War. And even I know that you will not buy when I say this time it is different, but the sense which we are getting from some global bulls is that this time it is genuinely different, because you have an artificially low interest rates and you have a tax cut bonus which is coming from America. So some would argue that the circumstances also warrant some degree of renewed thinking.
So, like for example, one of the best ways to compare the attractiveness of debt with equity is look at yield gap. And on yield gap basis today, the market is telling you that in India you have to invest in debt at this point of time, and that too low duration debt at this point of time. So I do agree that globally the market is in a big bull run, and today there are significant moats enjoyed by some of the US technology companies. But having seen markets for a long period of time, you don't know what causes markets to mean revert. It is not as if markets in US are cheap at this point of time. And so having said that, I am what I have learned from Sir Franklin Templeton is to be careful of these words called "this time is different." So I'll stay with that learning, because it has helped me in 2007. It helped us in 2013 to give a buy call, and it helps us to be slightly more cautious at this point of time. So I will not use the word "this time is different."
Argument here, and
I
again
must say one thing, that the government, by not allowing, I hope you are able to hear me.
Yes, Naren.
So I think one thing we have to keep in mind, one of the sensible steps that has been done this time is not to have oil subsidies. Because we did not have oil subsidies, I believe that we did not have a crisis like what Turkey had, or some of these countries had, because I think India's macro is in much better position than 2013, and it is not fragile because you have allowed rupee to depreciate, you have allowed oil prices to be passed on. If we had not done that, I think we would have had a Turkey kind of experience where the current account would have shot up, and then we would have currency depreciating at a pace which is very significant. Right now, we are all thinking that rupee is depreciated, but if rupee has depreciated over the last 5 years lesser than most other emerging markets. So I don't think rupee is a source of worry at this point of time.